why is infinite banking? Well, first off, can you explain what it is? And then second, why is it popular now all of a sudden?
Well, first, infinite banking is a cash flow management strategy. It is a capital preservation strategy. It is building an alternate source of financing into your financial strategy, all things that can make you more resilient. What it is not is a financial product. It is not magic. And I think that the reason it has taken off recently, it just has to do with, in my opinion, social media and the ability for anyone really to kind of position themselves as practicing or helping you implement infinite banking, which is a concept. It was not developed, but it was made popular, and the term was coined by Nelson Nash with his book, Becoming Your Own Banker. And that was late 90s, early 2000s, I think. People have since taken the term and just applied it to cash value life insurance, and specifically cash value life insurance, where you build high cash values early on. You don't really focus on the death benefit. You focus on the cash values. And so there's a difference between infinite banking, actually practicing the strategy and positioning the tool, which is the life insurance, into your strategy to be more resilient. There's a difference between doing that and simply buying a life insurance policy that focuses on high cash value. So does that help with kind of the differences there?
I've been hearing this term and this thing around for 4 or 5 years now. And every once in a while, I can get somebody to explain it to me concisely. But for the most part, no, I don't really understand what it is still.
I think my big issue with it, and Brandon, you and I have talked about this, and I think this is why we get along on it, is insurance is a fairly unregulated industry, right? And so I say that obviously it's got regulations and everything, but there are, my biggest gripe, right, is that every insurance rep I talk to says, oh, well, the reason that doesn't work is because every other insurance rep doesn't know how to structure this, but I do. And then you talk to the next guy and he's like, well, that guy doesn't know how to structure it. I do. And every single rep says that, right? And they, and they don't even know the difference between a direct recognition and a non-direct recognition policy and this, that, and the other, and all the other things. And they just, it seems to be touted a lot on social media as this almost get rich quick first level of investment strategy. And you hit the nail on the head right out the gate. Capital preservation, cash flow management. I think if you can overfund it, you need capital preservation. It's like the example I use for people is Susie Orman talks online about index funds, stock market, blah, blah, blah. But she invests in bonds, and people gave her a lot of flack. Well, you talk about this, but you do this. When you have a $50 million net worth, your investment strategy changes from quick growth to capital preservation. It's a different strategy. So same thing with insurance. A 20-year-old doesn't necessarily need to be as concerned about preserving capital as they do growth. And somebody who's amassed a ton of wealth probably makes a lot more sense to overfund an insurance policy as opposed to be worried about how much, I don't know if I'm explaining that right, but that's where I get frustrated about it. And when I see it in my Facebook group is people are like, cash out your TSP and roll it into whole life insurance. And I'm like, that should not be your first investment. No.
So